Welcome to the Golden Safe, where we discuss investments, stocks, and many more topics that will help you become more financially independent. In today's video, we will be talking about the 10 best high-yield ETFs to buy. Stock investors have a compelling alternative to holding individual equities in the form of exchange-traded funds. Investors can own an asset that trades like a stock but provides them ownership over various stocks with the help of ETFs. There are several different ETFs available. Some follow significant indices like the S&P 500 or the Nasdaq Composite. Others expose investors to specific geographic regions like China or developing markets. Others concentrate on certain industries like banking or technology. ETFs can assist in reducing the risk associated with stock ownership in a difficult market climate like the current one. This is because they eliminate the hassle of investing in individual equities and have lower volatility than individual stocks. Although they operate on a similar concept as mutual funds, they are less expensive and simpler to acquire and trade than standard mutual funds. Number 1. Schwab US Dividend Equity ETF. Assets under management, $44.1 billion. Dividend yield, 3.4%. Expenses, 0.06%, or $6 annually for every $10,000 invested. The Schwab US Dividend Equity ETF, $77.55, is the simplest spot for investors to begin their search for high-yield ETFs. This is one of the biggest Wall Street funds of any kind, and because of its scale and exquisite simplicity, it's also one of the cheapest, with a fee structure that most investors can afford, just a few dollars annually. SCHD is benchmarked to the Dow Jones US Dividend 100 Index, a simple methodology. As a result, this fund invests in 100 of the biggest, most liquid firms with high dividend yields. Additionally, organizations had to have paid dividends for a minimum of 10 years to be included. Number 2. SPDR Portfolio S&P 500 High Dividend ETF. Assets under management, $7.7 billion. Dividend yield, 4.1%. Expenses, 0.07%. The S&P 500 index of the largest U.S. firms serves as the starting point for this fund, which subsequently focuses on the top 15% or so equities with the highest dividends. This results in a much greater yield than most other large cap index funds with a portfolio of around 80 firms. That implies a major shift in the industry concentration relative to other broad-based funds. Which is maybe not surprising. Financials rank first with 22% of the portfolio, thanks to investments like Principal Financial Group. Number 3. Global X Super Dividend ETF. Assets under management, $748.5 million. Dividend yield, 15.7%. Expenses, 0.58%. Big profits are always relative, of course. There are possibilities with a yield that will make your eyes pop, as the aptly called Global X Super Dividend ETF, $8.36, should demonstrate. Wherever it can locate, this aggressive Global X offering prioritizes yield over all other considerations. This includes less well-known multinational corporations like the Chinese real estate developer Yushu Property Company and the Brazilian utility CPFL Energia SA. It also contains lesser-known American equities like Omega Healthcare Investors and Apollo Commercial Real Estate Finance, 2 REITs. Number 4. iShares International Select Dividend ETF. Assets under management, $4.4 billion. Dividend yield, 8.1%. Expenses, 0.49%. Although these businesses might not be as well known as the greatest Dow dividend stocks, they are multi-billion-dollar market leaders in their respective fields and household names in their respective nations. As a result, IDV's roughly 100 stock portfolio includes the mega miner Rio Tinto Group, the leader in Japanese shipping Nippon Yusen, and the Swiss financial institution Zurich Insurance Group. The top 3 countries in terms of exposure are the United Kingdom, 21%, Australia, 9%, and Spain, 8%. Because many publicly listed corporations in countries like the UK and Japan strive to entice pension plan managers as investors, there is a culture of steady and large dividends in many foreign countries. You may frequently discover 5% or greater payouts in this sector, even if you concentrate on leading large caps. Number 5. AllAmerican MLP ETF. Assets under management, $6.9 billion. Dividend yield, 7.0%. Expenses, 0.87%. It is easy to start with energy businesses when breaking down the universe of dividend equities by sector rather than location. However, the AllAmerican MLP ETF, $41.21, offers a lower risk option to play the sector with an emphasis on midstream activities, in contrast to riskier funds that play oil exploration and production equities. About 20 energy businesses, mostly engaged in the pipeline and storage industries, make up this high-yield ETF. They may thus produce more constant dividends than other aggressive bets in the energy industry since they are more dependable, more protected from the ups and downs of oil prices, and more reliable overall. Energy Transfer, Plains AllAmerican Pipeline, and Magellan Midstream Partners are the top holdings. Number 6. Vanguard Real Estate ETF. Assets under management, $35.2 billion. Dividend yield, 3.8%. Expenses, 0.12%. The biggest and most liquid real estate-focused fund of its kind is the Vanguard Real Estate ETF, $86.11. Additionally, it is the preferred method for income-focused investors to access the sector's dividend potential in a cheap index fund. It's important to remember the proverb that previous results are no guarantee of future results. Real estate is particularly popular for income investors since steady rent payments are the ideal platform for regular and large dividend payments. Furthermore, a certain class of Wall Street corporations known as real estate investment trusts are required to distribute a sizable portion of profits back to shareholders, much like MLPs in the energy industry have a mandate for huge payouts. Number 7. iShares Preferred and Income Securities ETF. Assets under management, $13.8 billion. SEC yield, 6.1%. Expenses, 0.45%. Beyond the different methods to divide common stock, the largest and most liquid vehicle for normal investors to play preferred stock is through the iShares Preferred and Income Securities ETF, now trading at $31.40. This asset offers the stability and income potential of traditional debt offerings, a sort of hybrid between stocks and bonds. However, it also carries a little bit more risk because it isn't protected in the event of default in the same way that stocks are excluded from bankruptcy proceedings. Big, capital-intensive companies typically issue preferred stock. Given that nearly two-thirds of PFF's assets are invested in financial institutions, it is probably not unexpected that the organization is slanted toward the industry. The remainder is primarily given to industrial businesses or utilities that require money for significant projects. Number 8. JP Morgan Equity Premium Income ETF. Assets under management, $16.4 billion. Dividend yield, 10.6%. Expenses, 0.35%. The JP Morgan Equity Premium Income ETF, $56.15, is one of the high-yield ETFs on this list that is arguably the most distinctive. This tactical fund resembles your typical, everyday blue-chip dividend stock fund in many respects. About 100 of the typical dividend stock suspects are represented in its underlying portfolio, including the pharmaceutical Eli Lilly and Coca-Cola, which is a part of Berkshire Hathaway's equity portfolio. JEPI also uses covered calls or options sold in exchange for a premium to boost the dividends on those equities. Additionally, the additional premiums from those options contracts contribute to the outstanding yield. JEPI yields are more than 6 times higher than the S&P 500 overall. The only way covered call options may be exercised is if the stock market has a significant rise. Covered call options are normally out of the money, which means the current price is already trading somewhat below the target price. Number 9. iShares IBOX Dollar High Yield Corporate Bond ETF. Assets under management, $18.7 billion. SEC yield, 7.6%. Expenses, 0.48%. Although equity-driven income investments have received much of our discussion thus far, no list of high-yield ETFs would be complete without a fund of junk bonds. With the iShares IBOX Dollar High Yield Corporate Bond ETF, $74.54, investors receive that. This fund, which manages the most assets in its category, consists of around 1,200 high-yield bonds from troubled companies. These companies, which include the airline American Airlines and the casino operator Caesars Entertainment, among others, certainly carry higher risk. But to compensate for that increased risk, these businesses pay much higher interest rates on their debts to attract lenders. Number 10. Wisdom Tree US High Dividend Fund, DHS. Expense ratio, 0.38%. Dividend yield, 12 Mo. 3.15%. Inception date, June 16, 06. The Wisdom Tree US High Dividend Fund, DHS, is a replication of the Wisdom Tree High Dividend Index, a fundamentally weighted index that includes corporations with average daily trading volumes of at least $200 million. The index is comprised of firms rated by dividend yield. The assets of the fund are well diversified across industries, including consumer staples, utilities, healthcare, real estate, and healthcare. Thanks for watching.